hear you. But, people were struggling to hear you. Private mode was still on, but can anyone hear Sam now? Can they just do a quick sound check?
Pardon?
Can anyone hear Sam?
I'll turn off the camera and hope. Yep. I apologise to everyone on the call for our obvious infrastructure issues this morning. So yeah, in cases where every requests for an equity redemption sale, there is the option from the board to gate those redemptions for a period, just to make sure that the liquidity remains fair to the remaining shareholders. Obviously, in a situation where there's a lot of redemptions, you don't want to be ending up trying to sell, the family silver. In order to satisfy those, you want to leave the business in as good of a position as possible. The current scenario planning that we have in place is that if those requests exceed 10% of the portfolio value, then that's probably where the board would then gate those redemptions. Should that happen, though, it's obviously clear that there's possibly a sentiment issue regards to how investors are feeling about the vehicle. So the board would go out to a vote to all shareholders, a continuation vote. If there is a vote to continue, so against a wind-up, then the board to decide when those redemptions can continue. This will most likely be once those existing equity holders have had their redemptions and the equity holders have agreed a new structure through a series of meetings, etc. We're very keen on that collaborative approach with those corporate actions. However, should there be a vote for wind-up, the company will seek to undertake to redeem shareholders out of capital as and when loan redemptions take place, and the monthly dividends will cease. The interest will only get paid out when basically one of those loan redemptions take place. All the interest has accrued to that point. One thing I'd point out, just to give a timeline for what a complete wind-up would look like. So the majority of loans are 5 years or less. Our longest one has just shy of 9 years remaining. The thing that I would say, though, within that is obviously there's the option for us to sell those loans onto other parties. We could probably get rid of around about a fifth of a book immediately. But after that point, it would just be slowing down as loans redeemed there. But the process is in place, and we haven't got to that point ever, fortunately. And we don't see a situation where that'd be possible to come up in the near term, which is always great. Just a very quick update on a few loans. There's a loan outstanding for Proplan for Leighton mixed use. Basically, the refinance is still progressing. One thing that's quite interesting from business is actually we don't mind loans becoming overdue, just because of the fact that that's when then penalty interest terms kick in. So your interest that we're receiving goes up 50%. We still have the security we're holding, so it's in essence it enhances our returns. It's more to pressure borrowers into action. It works, and it hasn't resulted in any costs to the business. So we don't mind that too much, so long as we have a plan in place, etc., as there is in this case. And another new loan that was drawn down this month, a very small position for us, that was taken up recently. On a bridge invest, so just a couple of updates recently. So that's not quite true actually for this quarter, it's for this month even. approximately 600,000 going into new loans there. As you can see, relatively low LTV, so we've got good coverage there in the event of a default. Bridging rates have come back, though, definitely. A bridge at over 60% LTV at 8% is certainly the lowest we've seen for a while. So that's something to bear in mind. One thing that I would say that we are looking at lately is we're trying to increase our exposure to longer dated loans, just due to the fact that it locks in that period that we're lent out for longer. Bridging loans are great for higher returns whilst you invest in them, but obviously the thing is that the money comes back and you need to recycle it, and there's that period when it's sat on your book doing nothing. So we try to we're looking at now the bridging rates are coming quite short, just to get something a bit longer going in the book again. Beach equity, so 2 loans here. So Project Satchel is a loan, actually holds quite a lot of interest rates. It's around about 16%. They've had 2 so basically it's like a schools management software business. Definitely a very large player within that sector. They've had 2 approaches for the management side of their software in the business, which have been rebuffed by management. So they're certainly interested in the business. It looks though like the loan is going to run over, but there is the value there, which is there. It's just to keep monitored on, because it's probably going to run over. Project Pendine is a manufacturing business that creates accessories for Jaguar Land Rover, Volkswagen, et al. You kind of like the whether it be like branded roof racks or luggage, those kind of accessories. We were worried last year because obviously being a revenue comes from Jaguar Land Rover, and Jaguar Land Rover last year, well, basically decided not to sell any cars for a year, which had us a bit concerned. But actually, it's been going really, really well. So on top of the 10% interest that the loan carries, there's a series of warrants. So that's basically like financial instrument that's linked to the value of the equity in the business. Very happy to say on our £250,000 loan, those warrants are worth about 80,000 at the moment. So obviously on a percentage basis, that's about a 30% increased return. One thing I would say is I never include that anything that's like warrants or anything like that in the net asset value calculations of the business, just because they are quite hypothetical in nature until they're realised. So be aware that when you're looking at the your investment value, there is also a few areas that we can't put into it formally, but they're there in the background. So that's quite interesting. And then Drive Simple is the van rental company which we have lent out. It was 1.3 million. It's now just under 1 million, being repaid, capital and interest payments rather than just interest. Had a meeting with the director earlier this month. They've been on their payments. That's running at 15% interest, all of those loans, and obviously the secured security vehicles. I got through even how it turns out. So that's good, and we're getting our interest on the vans noted on the motor trade policy, just to make sure that if any vans get written off, then come straight to us there. Look at our holding return, so above target, 5.06%. The dividends over the last year have been excellent. Sorry, over the last 12 months have been excellent. 6.7% dividend. It's really happy with that. Obviously, as dividends get paid out to large amounts, if there's a lot of accrued interest, then the capital value of the shares comes down a little bit, which you'd expect, but good return all in for the last 12 months, especially when you compare it to our peers. So updated this this morning, though we are outperforming on a 12-month basis everyone bar Rockwood Novus. That's actually the first time they've ever outperformed us in the last 6 years that we've been in trading operation. As you can see, last quarter that wasn't the case. We've even got one competitor there that's still in a 12-month loss of minus 3.75%. So very happy with our 5% return over the last 12 months, particularly when you take the mean of all of those is 2% for the last 12 months. You know, that's quite a bit of extra return there for our shareholders, which is always what we're here for. How we see it as a snapshot right now. One thing I would say is this flatters a little bit, just in the sense of we held quite a lot of idle cash for quite a lot this quarter. So this is the best this has been for around about 2.5 months. The headline figure for equity holders is this line here. So as of today, it's running at 6.34%, which is obviously fantastic and in excess of our 12-month rolling return, so that's good. The idle cash that we held over brought that down to a worst case scenario of about 5.5%. So we're somewhere in between that range over a trading period. But to see kind of like the alternative platforms kind of like running average at the moment at 4.73 and still carrying an awful lot of cash. But it's good to see that even if you were to hold this within an ISA, you would actually be receiving a smaller return than you would actually somewhere placed. So even after paying tax, we're outperforming, which is great to see there. Our average loan is running at 9%, and actually over the next year or so, there's a couple of facilities that will around about 7%. That we'll be able to move back into like an 8% environment. So I expect that to move up about 0.3% over the next year, which is always good. I'd like to compare this to the savings market because some people, this isn't necessarily a business relief kind of vehicle. This is an income vehicle, and just to compare to what else is out there. So these are personal savings market rates, but you can see quite clearly that is obviously out of date. It's 5.06, but still you can see far in excess of anything else you can see out there. But all of these would be liable for income tax in personal names, whereas this would be dividend taxation, so a slightly lower rate of taxation. So happy there. And on the business, I see on an average savings basis, it flatters better. These were best buys, but as I said, we're still outperforming that. On the business case side, so if you have excess savings within your business and are looking to deploy it, see from best buys here, you're talking around about 4 to 4.5. So we quite a bit of a spread there over and above, which is always good. You know, we are very happy with how the loan book sits, with also how with the range of loans that we've got going on. Very well diversified at the moment. It's over 100 loans, over 85 funders. So we are They're happy with our diversification. If any one loan was to go bad, strange, we still haven't had in 6 years a single capital loss, which in a lot of ways is very good. Means that our underwriting has been on point for the last 6 years. On the other side, though, it seems sometimes like if I go out to people and they've not had a capital loss, I kind of go like, well, could you lean into risk more? That's not what we're looking to do here. We're wary of who our shareholders and our wider stakeholders are, and actually that this is more about having a secured vehicle and it being managed diversely and professionally. So we're happy with that element here. And then come to the end there. So I apologize for the lateness starting this webinar. Could do a cross sell here and talk about the podcast, but that's a different product that we manage. And also unfortunately the internet signal keeps on dropping in and out. But otherwise, yeah, Isa, over to you.
Thank you, Sam. Can you hear me now?
Yeah, you're
Thank
good.
you, Sam, for that. We will now move over to the survey. If you have a minute or two, please just fill in the survey. And if you have any questions, please do ask the survey. There we go. And thank you, Sam. Anything else? Guys, have a good day further. Good.
Yeah. My last little webinar for a couple of months, so get a bit of time for me for a couple of months. But hope you all have a good day.
Cheers, Sam. Thank you.